Welcome to the channel. In this video, we will be discussing the recent collapse of Silicon Valley Bank, which took place in just 36 hours. Silicon Valley Bank is located in the heart of the tech industry in California and primarily serves technology and innovation companies with financial services. During the pandemic, the U.S. federal funds interest rates were near zero, and the Silicon Valley Bank invested billions of dollars in U.S. government bonds, which are generally considered a safe investment. This allowed the bank to accumulate a large amount of cash reserves, which it used to lend to tech startups and other clients. However, in 2022, the Federal Reserve started raising interest rates to combat inflation, causing the value of the Silicon Valley Bank's holdings to decline and creating difficulties for the bank and its tech company investors. Tech companies were pumping in more money to protect their investments, and the bank had difficulty raising new capital during this time. The crisis at Silicon Valley Bank highlights the potential negative effects of economic policies such as zero-interest rate policies and the importance of carefully implementing such policies. The bank's investments in government bonds, which were once considered safe, turned out to be risky in this situation, as the interest rate rise caused their value to decline sharply. Another major contributing factor to the bank's collapse was its risky clients. SVB took risky clients, which caused them to move their money out quickly when things went off the rails. This caused a sudden decline in the bank's liquidity and made it more difficult for the bank to continue lending to its clients. Regulations on smaller banks were rolled back under the Trump administration, making it easier for banks like SVB to take risks. This allowed the bank to take on more risk than it could handle, ultimately leading to its collapse. SVB took in a lot of cash during the pandemic and used it to buy longer-term U.S. Treasuries and government-backed mortgage securities, which are usually considered safe. However, when interest rates rose, SVB's investments were worth $17 billion less than their fair value. As interest rates rose, new deposits shrank, falling nearly $30 billion from March to December, leading to a run on the bank and ultimately causing its collapse. The bank had difficulty raising new capital during this time and was unable to keep up with the demands of its clients. The bank's collapse highlights the importance of careful risk management and the need for banks to be prepared for sudden changes in economic policies. In conclusion, the collapse of Silicon Valley Bank in just 36 hours was caused by a combination of factors, including its investments in government bonds, its risky clients, and the loosening of regulations on smaller banks. The crisis at Silicon Valley Bank serves as a warning to other banks to be vigilant in managing their risks and to carefully consider the potential effects of economic policies such as zero-interest rate policies. Thank you for watching.